All right, as we near the end of Chapter 6, we're just going to talk about what happens when there's errors that happen. Miscounting, oh, whoops, we forgot about that whole box or that whole pallet of inventory. And how does that affect both the income statement and the balance sheet? And then I'm going to teach you for the first time in this class what are called one of many accounting ratios. It's just some simple math that accountants use and then upper management and analysts use to place a number on the health, the financial health of the company. So that is what today includes. 2 short sections with just one little end of chapter problem with each. So nice. So inventory errors, just like anything, humans are going to screw up. And even if it's a pretty sophisticated and automated computer system, humans are usually behind the controls. So there's a few different reasons inventory errors occur. Failure to count or price things correctly. Someone is probably counting that end of inventory stuff. And then what happens when they're counting and then someone wants to buy the stuff that they're counting? Well, there's a lot of hands in the cookie jar there. Not properly recognizing the transfer of legal goods in transit. So basically, errors in the stuff that's being transported. Who owns that? What happens if it ends during the fiscal period? Then where does that inventory go? So just the complexities of goods in transit can cause errors. And what you need to know, if there is an error specific to inventory, it's going to affect both the income statement and the balance sheet. Let's talk about why. Inventory is an asset. And so if you overstate or understate inventory, like if you have too much or not accounting for enough, it will throw the asset valuation off on your balance sheet. And it also will throw your cost of goods sold and cost of goods available as contra revenue accounts off on the income statement. So it's going to look like you either have more revenue than you do or not as much revenue as you do, which of course then will impact the bottom line or net income. Let's talk specifically about income statement stuff. Inventory errors affect the computation of cost of goods sold, and then of course we'll have an effect on net income, as I just mentioned. If you remember, this is that top portion of, these are basically impacting revenue. Okay, so I'm going to talk about a couple errors and then how that affects cost of goods sold, which also affects net income. So write them in on your little handout as they pop up. If inventory is understated, so in other words, we have more than what we say we do and it's understated, cost of goods sold is going to be understated. And then it's going to look like we're making more money. Because if cost of goods sold is understated, it's actually going to look like we're making more money. Because it's like we have less of an expense, or in this case, less of a contra revenue account. In other words, it's going to look like we're making more money. If we overstate our beginning inventory, so we say we have more inventory than we do, and we're going to also have appearingly more cost of goods sold, making our ending net income be less. Because if we have the more cost of goods sold we have, the higher this is. Remember, that's a contra revenue, or think of it as like expenses cousin. The more we have, the less money we're making. And so if we overstate it at the beginning, it's going to make our cost of goods sold go up, and it's going to make our net income go down. Finally, talking about ending inventory. If we understate the ending inventory, so the shush, we'll see an overstated cost of goods sold again, and then an understated net income. And if we overstate, or we say we have way more inventory still on the shelves or shush at the end, you'll see an understated cost of goods sold, making it look like we have more money than we do. So get all of that in, and then we'll talk generally about it. Overstating, saying we have more inventory than we do. Understating, saying we have less inventory than we actually do. Driving cost of goods sold up or down. The higher the cost of goods sold looks or actually is, the lower our net income will be, and vice versa with a lower cost of goods sold. Just remember, cost of goods sold is like expenses cousin. It's a contra revenue account that offsets the money that we get to keep. Can I move on to balance sheet? How does this affect the balance sheet? Remember, the basic accounting equation is or ending inventory error. So the stuff that's shush. Someone is counting what's left on the shelves. What's left on the shelves is considered an asset because we own that inventory. If we overstate that, we say we have more than we do, it's going to look like assets are bigger than they are supposed to be, and it's also going to make it look like we're worth more than we actually are. Because remember this. We send little Johnny to go count all of our inventory, and if he says we have more than we actually do, it's going to make it look like we have more assets and making it look like we're worth more. If it's understated, if Johnny forgets to count a whole pallet or a whole section and it's understated, it's going to make it look like we own less and we're worth less. And our financial statements will be incorrect. Remember what we just did on income statement? All of that stuff, that affects the balance sheet as well because that net income goes into the owner's overall worth as well. So it's a problem, and you have to have accurate inventory. Just remember, overstating says we're saying we have more than we do. Understating means we're saying we have less than what we do. And that's really all this section is. I want to roll into the final section, and then we'll do the two end of chapter bits together. In this last piece, we are going to run some financial ratios to analyze the health of our company. Before we do, it looks like they're going to just talk about balance sheet and income statement a little bit further. Basically, they're just saying, again, remember, inventory is an asset, but we'll probably use it within a year, so it's considered a current asset, reminding you one more time that that's where inventory would show up. Now, that's on a classified balance sheet. Remember, classified balance sheets have 4 subcategories of those assets that we learned in a previous chapter. But we probably don't want that inventory hanging around for multiple years, so that's why it's considered a current asset is going to be used within a year. Income statement, what's impacted here by all this inventory talk is basically taking a look at what we're selling. We're selling, of course, our inventory. We don't get to keep that pure revenue because there are what are considered costs of goods sold, which is a contra revenue account that's going to offset the value of that sale. Again, they just wanted to reiterate those points. merchandising companies not only are going to present all of this on financial statements, but they need to disclose it. They need to tell a little bit more of the story of a number of things. If they're, a Superior Westmore business where they've got raw materials, work in progress, and finished goods, they should probably disclose that we're not just rock and finished goods. We've got other stuff that contributes to the value of our inventory. They'd need to mention their basis of accounting, whether it's cost or lower of cost market, and they should disclose somewhere on their financial statement which costing method they're using, FIFO, LIFO, or average. Don't forget there's a fourth. That the book says is pretty rarely used. What's the most natural costing flow? FIFO. You sell the old stuff, cycle in, then new stuff becomes old stuff as you buy more. So basically what this is saying is all these financial statements, you better have a little disclosure or like a little asterisk saying, we run this costing method, we base our accounting off of this, and if we're a merchandising business that's also manufacturing, those extra inventory bits play into it. So as we analyze, I love how the book describes this. Inventory management is a double-edged sword. Write that down or highlight it in your notes if it's already there. Or you could say that the inventory management team walks a very fine line. Because too much of it is considered a bad thing and too little of it is considered a bad thing. High inventory levels, so if you've got excess everywhere, could be considered a bad thing because it costs a lot of money to have it laying around. And it proves that, and I'm going to use liability in this class a little bit loosely. It costs money to have it around, plus it's sitting there for taking, whether it's the employees that are going to take it or customers that are going to take it. The theft level increases as it's there. How are they going to know if I grab a Snicker bar off that pallet? Kind of thing. Beyond the fraud side of it, the longer it sits around, the more likely it could be damaged, whether it's being moved around, whether it's more susceptible to fire or a tornado wiping out the warehouse. Probably, it costs a lot to store it. It costs a lot to insure it. And you run the risk of it becoming obsolete. You don't want a bunch of lawnmowers hanging around come November, December. Now, are they going to go bad? No, spring will eventually show up. So they're obsolete for a few months. You'll be able to try to sell them again. But then what happens when the latest and greatest model comes out? Do you see where with electronics they become obsolete very quickly? Okay, so you got to be careful about that. Now, there's also the double-edged sword from the other aspect. If you have super low inventory levels, you're going to have unhappy customers. If that size isn't available or that model isn't available, they're going to go elsewhere. You're going to lose sales. So you can't have too much laying around, but you can't have too little, hence the double-edged sword notation. So as the management of the inventory person, you wear the management crown of the inventory. What's the secret recipe? What do you do? Yes. You have the one out on the shelf, like this is the last one. But really you have several in stock in the back. Ooh. Play on economics a little bit. Have you been the customer in number 2? Mad because your size isn't there or your style isn't there. Okay. Have you been the customer in number one where they're trying to liquidate? They're trying to get the lawnmowers out of there because it's going to snow. And you get to take advantage of a liquidation of inventory. And that's smart. That's the way to go. You know, you might drop the price a little bit, but you want to clear the shelves. You want to reduce the stuff that's still here. There are ratios to help guide you in making these decisions. There is the inventory turnover ratio that you need to calculate the days in inventory. And then we're going to do this once, and then we're going to look at a company like Walmart, and then we're going to do this for end of chapter stuff as well. Inventory turnover, the inventory turnover ratio measures the number of times, on average, the inventory is sold during the period. Its purpose is to measure liquidity. So taking the inventory and how many times in the period, most often that period is a year, will equal a sale in the form of cash. Now we can sell based on AR, but AR ends up being cash. So basically, how many times can I sell this trinket, get it as liquid as possible, or turn it into cash in a year? Have any of you ever been at a Walmart on a Saturday night? You know, I know you're one of them, yeah. And you walk through, I'll just use the toilet paper aisle. It's wiped out. No pun intended there, okay? I've been there, and there's like literally 2 or 3 things of toilet paper. Just think about even how many times that inventory is turning over on a Saturday. I've heard they restock their shelves several times on a Saturday. And by Saturday night, they're tired. And then their inventory team comes in and updates all the inventory. But you just watch, like on a busy shopping weekend in some of those big box stores, it's wiped out. So inventory is turning over many, 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 many times, even in that day. Okay. Now still they have that stuff in the warehouse, in the back room, so to speak, that so the inventory is technically still there, it's just not out on the shelves. So here's how you calculate it. Inventory turnover takes into account cost of goods sold divided by the average inventory that you're rocking during that period. Now to get the average inventory, you have to take beginning inventory plus ending inventory divided by 2. No, it's minus. Sorry. No, it's plus. Gosh, it's average. Come on. Sorry. Beginning inventory plus the ending inventory divided by 2 will equal the average. Okay. From there, you're given an amount that's how many times you take your inventory and turn it into cash in a year. Okay, now in a store like Walmart, they might have different inventory turnovers for different departments. You know, they're selling toilet paper a lot versus maybe not as many TVs. So maybe not quite as many electronics as those household consumable products. So with a big box store like Walmart, the inventory turnovers might vary by department. Okay. From there, you take days in inventory. It basically measures the average number of days inventory is or on the shelves. This is the approximate time it will take a company to sell inventory once it arrives at the store. So when the shipment of toilet paper backs up to The loading dock at Walmart, that shipment, the stuff that's going to go out on the floor, the stuff that's going to stay in the back room or warehouse, how many days is it going to take to sell that? And to calculate that, you just take 365 divided by that ratio that you just calculated. Yes, I would say so. The question was, do you think Walmart has this kind of stuff for every single product? I would say yes, being the multi-billion-dollar corporation that they are. A pretty sophisticated inventory management, I would assume. So let's put this into practice. Speaking of Walmart. Walmart reported in its 2011 annual report a beginning inventory of 32 million and an ending inventory of 36 million. And cost of goods sold, 315 million. They want us to compute the inventory turnover as follows. This is, and they just did it in more of a horizontal fashion. If I did COGS divided by average inventory, that would be the vertical look. And remember, average inventory is beginning inventory. Sorry for my mistake on that earlier. Plus ending inventory divided by 2. So cost of goods sold. Oh, spoiler alert. Looks like I did my animations in the incorrect order. Cost of goods sold, where was that? Plug that in and it's million. Here is the average inventory, the beginning, plus the ending, divided by 2. So inventory turnover is happening 9.1 times throughout the 12-month year. So think of a Walmart with all of the mass amounts of inventory in the store and in the back room. They're completely wiping that store out and filling it with more 9 times, 9.1. Now, specific departments I think would be more, and other departments would be less, but on average, Walmart in 2011 was completely, I mean, think of every can of soup, everything of toilet paper, every paint can, every flower pot, and every toy on those shelves. They're completely doing it 9 different times. From there, we would take 365 divided by 9.1 to find out that's happening every 40 days. 40.1 days to be specific. Now, I talked about the toilet paper at Walmart on a Saturday night. That's wiped out because people were shopping, okay? But overall, the whole store, to completely refill that place 40 times, that's crazy in a 365-day period. And as my little notation reads, these are typical figures for big box stores like Walmart. I would, on your notes, write this in. Companies that keep their inventory low and their turnover rates high not only are going to have happy customers, their financial health will be rock solid. Because they're managing to keep inventory levels low and they're turning it over. Customers are buying it a lot. Customers are going to be happy, but a financial success will occur out of the deal. these two ratios. You need this one to calculate how many days it's actually occurring. So these two go together. Don't forget about average inventory. You might call it that, but every time I do this, I always just put this full beginning plus ending divided by 2 in. And that, my friends, is the chapter. Let's go to that other handout so we can complete our end of chapter work. Forgive me about the bad printout. It's better than the mass amount of extra workbook pages that I'd fill your binders with. Brief exercise 6.8 is in relation to 6.3, section 6.3, talking about over and understating. Brief exercise 6.9 is about section 6.4 that we just talked about, completing those ratios. All right, so let's do 6.8 first. We basically are taking a look at an overstating, understating issue and how that's going to affect the income statement and the balance sheet. Okay, remember, income statement is in relation to COGS / net income. Balance sheet is in relation to that inventory asset. I made a note before I even did this. I basically said we have $7,000 worth of inventory sitting around than we originally thought. There we go. So I read the bio. Pettit Company reports net income of $90,000 in 2014. However, ending inventory was understated. What is the correct net income for 2014? What effect will it have on both the balance sheet, and we're even going to mention the income statement. So it was understated. We actually have $7,000 worth of inventory sitting around on a pallet, in a back room, on the shelves, in transit than what we thought. So we have an understating issue, correct? Because if we reported 90,000, but it was understated by 7, what's going to happen? It's going to look like COGS is higher than it should be. And it's also going to look like we have less of a net income. So to correct it, our original net income was listed at 90,000. But we have to add in that 7 that wasn't originally in there to equal an actual net income of 97,000. I'm going to read to you the exact word for word from the answer key, because if you're fuzzy on it, this hopefully will solidify any worries. The understatement of ending inventory caused cost of goods sold to be overstated by $97,000 or by $7,000, and net income to be understated by 7. The correct net income for 2014 is $97,000, or the 90 that originally was listed plus the 7 that was understated. From the balance sheet side of things, assets were understated by $7,000 because remember, we own that inventory, and if we didn't know we had 7, it would have been $7,000 less than what it should have been. The little charts that I gave you in your supplemental handouts are valuable. I can explain it to you one more time if it's confusing to you, or just reread that section of the chapter and I think it'll start to make sense. Basically, overstated and understated is just what do we have that we didn't know about, or what do we have too much of that we had an error on. And then let's do 6.8. Excuse me, 6.9. I hope you wrote smaller than I did. Ratios. Let's write the inventory turnover ratio before we actually plug any numbers in. Inventory turnover ratio. How many times inventory turns over in a period? Equals COGS divided by average inventory, which we know is a little math problem in and of itself, where you take beginning inventory plus ending inventory divided by 2. See if you can do it based on the numbers that you see in 6.9. How many times is it turning over? 5.4. How did I get 50,000? What does that mean? What was my beginning inventory? 60 plus my ending was 40. So $100,000 divided by 2 would be the 50,000. Okay. 5.4 times. How many was Walmart? 9.1. So this business either is in less of a retail area, maybe doesn't move as much inventory, maybe has really expensive prices. What's that? Or large items, okay. Then we're going to run our days in inventory ratio or calculation. We're going to take 365 divided by 5.4. How many days, how often are they rolling this thing over? I heard someone start to say it. 67.6. Every 67 days, they're completely revamping inventory. Now, let's analyze this a little bit, even though they don't tell us to. If I'm the accountant and I give the management or the boss these numbers, I sit down and say, we've got to do better. How are we going to get this up? How are we going to liquidate inventory more often? What do you think? Look at some of the numbers. Come on, boss. What can we do to liquidate more fast, more often? Got to get our cost of goods sold down a little bit. We've got to have less inventory hanging around at the end. We started with 60 and we're down to 40. We've got to sell more of that. Let's run the numbers a little bit differently here. What if we started with 60, but we ended with 5,000? Someone run the number on that. What's 60 plus 5? 65 divided by 2? What's 65 divided by 2? What if this number was 32.5, 32,500? Someone get that calculator out and do that. What's 270,000 divided by 32, 8.3. Take 365 divided by 8.3. Okay. So we sit down together and say, all right, if we can get, we got to sell. We got to sell. Instead of $40,000 worth of stuff laying around at the end, let's get that down to 5. That's a big push. Sell, 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 or reduce our prices, or we'll do whatever we got to do. But look at how, look at how much more we're selling then, which is only going to, or how many more times we're selling. It's only going to equate in a healthier bottom line of net income. That's all I have.